ratio, but you know that for something that this transmissible, 85-90% of the people have to be exposed for it to peak, right? So the shape of the curve tells you that once it peaks and starts coming down, then you know in hindsight what the symptomatic versus asymptomatic ratio is, because the assumption is that 90% of people have to touch this, right? Either or be immune to this, either from prior immunity from vaccinations or prior infection, or touch it again. So the fact that the cases peak way lower than we thought and way faster, so the area under the parabola is really small, means that like the asymptomatic to symptomatic ratio is really high, which means it's not really that dangerous. And so then so the hospitalizations have already peaked in South Africa and come down. And so then, and you don't just take the hospitalizations. So when you just go the hospitalization rate, you can take the hospitalization over positive case test rate. But you're really just going to take the hospitalizations over the entire population, because the whole population of that province has been exposed to it, and has either gotten it or not able to get it. So you have real data, and then it's like, okay, well, South Africa is different because it's a younger population, and only 20% are vaccinated, and they've been hit by natural, like South Africa's had 3 real waves. So like everyone there has been hit 3 times. And so then, well, what's going to happen when it goes to London? And it's very similar curves in London. So it's like, okay, and actually it's out competing Delta, and it's way safer than Delta. So it's really what's turning out is the bullish arm to all this stuff, which with the exception of China. And when you look at China, they have a 0 case policy that's not working. Like they're tracking water, shutting down neighborhoods. That really worked for Delta and every other variant, but it's not working for this one. So they have to change. Well, I'm not sure what they're going to do.
That's interesting you said that. Like because we've been doing a lot of work in just like kind of like one of our other thematic questions is just the supply chains disruptions, changes. I think the 0 tolerance policy for them has actually been much worse, as opposed to like if you're shutting down individual provinces, like so port shut down, and it's open to shut down, and we can't have the like consistent policies to make things work. So it's just we found that actually to be even more disruptive. But I don't know. It'll be interesting to see like what they do about it. So it's kind of an interesting point as well. So.
Yeah. But I mean, what's coming out with Omicron X China is the most bullish arm of this, and but then what has to happen is all these rules have to change. When you think about the rules that are in place that the governments haven't instituted with all the best intentions, vaccine, and I'm apolitical on. I can get into politics, but my views on this are totally apolitical because I'm trying to be an investor.
Yep.
But it's like you have, board, and you see these rules starting to change now, even in Canada, because we're very conservative on this. But what's happening is if you want to cross the border into Canada, and you have a positive test that's more than 14 days old, you don't need to test again, because what you find happening is that once you test positive for Omni, you can test positive forever, like on a PCR test. So if you have a positive test that's old enough and no symptoms, they let you in without another test. So it's like a passport. But then you have these vaccine mandates when vaccines don't protect you against anything. Like they don't protect you against transmission Omni. So like the fact that like we have an office with 10 people and all of us are vaccinated, all that stuff, but if one of us wasn't vaccinated, that doesn't increase the risk to anyone. You know what I mean? Like, it doesn't really matter. So then you would need governments to change the rules that they've instituted and these policies, because really, they should just. Well, what South Africa's doing is they've stopped testing. They have no limitations on anything, and they say if you're sick, you stay home. If you have symptoms, you stay home. If you test positive and you have no symptoms, go to work. It doesn't matter, because this is less deadly, less harmful than the flu, and they know this, so they've just taken away everything and they're letting their country go. And that's what everyone has to get to. And you're just like, is that realistic that a blue state or Canada gets to that point where they say, actually, we don't really care about anything, it's gone? Because that's what South Africa's at. But the CDC is going there, like they went from 10 days to 5 days. right? So there's practical stuff to this. So I think that, there's a real full-on this is gone scenario that's happening now.
Yeah, I think I haven't really been out of Texas, I guess, in a while, but just can't. And it's kind of funny of just like people like Christy that will travel from like other states that are much more punitive, and just kind of the reactions to the differences are, I don't know, seem generally positive unless you're just kind of telling up that. But I don't think it's starting to get some people fed up in other parts of the country. So
yeah.
Even in the extremes of California.
Yeah, I didn't say it. So,
so Canada is very similar to California in terms of our political views, and I'd say even probably more conservative in regards to like this health stuff. Like, so we're more afraid, and OMI is ripping through Toronto, and my friends who've been very scared previously, they've gotten it. Their kids have gotten it. It's nothing. It's a flu, a mild flu, or like 3 days of a fever, but like it's nothing worse than a flu they've had. And when you talk to these people, they're just like, I'm not scared anymore. And so it's just like, I don't care. And these are people that have been really tight on everything. Like, there's someone on our hockey team with COVID. They're like, we got to shut it down. And we would shut our hockey team down for 2 weeks because one of the kids had COVID, which happened numerous times this year. And these same people are so that will happen as this thing rips through, because you're like, okay, well, everyone I know has it or has gotten it, and no one really got sick. And so then you're like, why am I afraid anymore? And then I think that kind of happens, but we'll see. The China thing's tough though. That's a tough one. That's a big part of global GDP. And a big part of commodity consumption.
Well, I think maybe that's a good segue into, look, it's been a while since we spoke, so I'm always happy to give you guys kind of updates on us, but I would love to get, I just looked at the exposures, kind of the letters of where the book has shifted now and why. So, still see lots of commodities, materials, but just kind of other areas of interest, and then maybe like some of the broader reasons of why you have, what you're finding in those types of sectors that are really making you hone in there.
Yeah. Okay. So on the long side, one is run through like the buckets of long exposure.
Yeah.
And Chrissy, if I forget anything, if I miss something, let me know. I'm just going to speak from memory from the last time I looked this morning.
Sure.
I think we're about 20-ish, 25% net long oil and gas. When I look at from a high level, when I look at the supply and demand for oil at trend demand levels, so like if you take trend demand from 2018, 2019 and extend that out to 22 and 23, which were below trend demand by about 1 million barrels a day ex air, and we're about 4 million barrels a day below trend demand, including air travel. And we think that maybe we have 2 million barrels a day of excess capacity. So you have a scenario that's on almost any normal growth rate is severely undersupplied. The solution, and then what we've learned through the last year, is that the U.S. shale guys are not growing unless they're not growing at what they could grow, and there's numerous reasons for that. One of them is that they, you could say they found religion, or you could say that they don't have that much drilling inventory. But either way, it doesn't matter. When you look at the supply growth pre-COVID, over the last 6 years pre-COVID of the supply growth, all of it was from the U.S. So when you start growing from any place, whether that's right now, say even if the 3 million barrels a day of international air travel doesn't come back, which it will at some point, even if you start from here, you look out a year and you say, okay, well, we're going to trend demand's growing 1 million, 1.5 million barrels a day without that snapback. Where is that going to come from? And it's very difficult to find that, and I think the world still has a problem. And then when you look at the valuations, the CEO of Fang said this the best, where he's like, I'll start growing again when I trade at a fair discount rate using mid-cycle oil prices. And so, we think mid-cycle oil prices are 70. And so if you take a 10% discount rate at $70 oil and run it through what we own, all of them have at least 100% upside to them. So these stocks based, this isn't on multiples of cash flow. This is just straight high discount rate net present value of what they have, which is 9 to 15 years of inventory, depending on the name. So we think these are severely undervalued companies, and there's lots of micro reasons to own the individual companies we own. A lot of them are deleveraging very quickly, and you've seen companies re-rate on multiples and NPV and discount rates when they go below 1x debt to EBITDA. And so, we have two companies that are at 1.5 that trade at half price on a multiple, and they'll be below 1 in 6 months. And so we have those specific reasons, and then we have companies in Canada that are drilling bigger wells than they had before that we think are beat and raise stories and increases their NPV per share versus street. And then we have one large cap that's, again, half a turn still too levered. So we have our micro reasons why we own the companies we own. And one of the things we're also realizing in energy is that there's no exit, there's no buyers for any assets privately. So the only buyers are public companies. And if anyone needs to sell, they're selling at discounted rates to where the public guys are trading. And so there's also the upside of a bunch of accretive acquisitions coming over time. So we own two companies that have done, one of them's done 2 accretive acquisitions, the other one's done 1. And so, one of the trends with institutional investors leaving energy space for ESG reasons is that the private equity funds are not able to raise new funds. And so when you look at exits, the only exits in IPO, because the oil stocks are still so cheap, why would you IPO something that's small versus just selling it at a discount and taking shares in something? So we've seen that. We've seen that kind of exit via M&A to public guys. And so, we've looked at different ways, a little more creative ways to be longer oil, and actually it comes back to owning the public companies we own for lots of reasons. So,
well, one thing you'll like is one second. I'm getting a spam call come through. You might like this strategy because we've been adding a fair amount into energy exposure, and like for a lot of other, there's kind of some inflationary reasons for all of that. Sorry, spam callers. So it pulls up on the iPad. But one of the strategies we've been doing is buying secondary funds of oil and gas,
that's smart.
Development funds. And if you think of your an American development fund 5 years ago, now it's a producing asset.
Yeah.
And we've been buying them from your kind of ESG focused endowments or foundations on one of the coasts. And it's crazy. There's no buyers. We're getting high quality producing assets for 40 to 50% discount. So
yes. And then if you want to exit that, we don't have the ability to do that in our structure. But if you want to exit that position you have there, so if the private equity funds that own that want to exit that position, they have to sell it.
Yeah.
They have to sell it at a discount to whatever because you can't IPO that, then there's no buyers for that, and so they have to sell it to a public company at a discount.
Well, and I think that's the interesting thing.
Which is okay,
yeah.
Right? You buy it here, then you issue it, you get equity in something that is part of this, accretive acquisition. So, yeah, it's pretty cool.
And then we get you just think of the yields on these and our cost basis, you get your money back pretty quickly. And then it's maybe you take a hit on exiting the asset, but it's a nice way to.
Well, I don't think you'll take a hit.
In terms of the asset price, when they exit it.
Well, no, you'll just have to sell it at a discount to the public guys. That doesn't mean that it's not. It's down from where you bought it. I don't know where you bought it. If you bought it at a 40% free cash flow yield, that's. There's the average. Yeah, but we own 2 companies that have 40% free cash flow yields that are public. but the majority of the guys are below 20. And so we own 30 to 40 that we think once they go below 1 times levered, we'll trade to 18 to 20. And then the 18 to 20 are misvalued as well, because if you NPV what they do at 10%, they're up 40, 50%. And then the stuff that we own that's, we think better risk reward is up 100 to 200%.
Well, I think, and I think maybe the next question I would have in terms of more of the profiles. So, like, the companies you're looking at, and let's just start with, like, oil and gas. And this is maybe highly stylized, but, like, kind of what we feel that we've seen of some of, like, your majors that are just, like, there's no growth, there's no development. It's like, we're just going to, generate cash, pay down whatever debt's remaining, but you're not growing whatsoever. There seems, you can still find your more speculative growth things, like on the smaller side. Yeah. And I think what we've kind of found the sweet spot is more quality names that, over the past couple of years have really delevered, have found some sort of religion, but there's still some growth in terms of development.
Like 4 to 5% growth or something like that,
Yeah, and ideally, hopefully you can find some gems that are underappreciated growing quicker than that, but maybe in terms of when you think about the E&P universe, or like the names you're looking at, like, does that profile resonate with you? And in terms of like kind of the things you're finding the most interesting, or feel free to add.
So we own Canadian. We have 2 big positions in Canada, and we like both of them because they're small enough that they can grow, and their acreage position is massive. Paramount, which is our largest position in our fund, has 40 years of drilling, and so and they own a bunch of infrastructure that's underutilized, so they're supposed to grow, right? And I think they're going to. And the market's not punishing them for. They've already announced that they're increase their capex and they're going to grow, and the market liked it in Canada. Because there's no growth in Canada and there's like only a bunch of small companies there. Then we own Laredo Petroleum, which is growing by acquisition. They can't grow because they only have 7 years of inventory. And what they've done is gone from 2 years to 5 years to 7 years by making 2 acquisitions, and one more acquisition they get to 10 years of inventory, which puts them on because their wells are fantastic, and then they're less than 1 times lever. That puts them on the Goodco comp sheet. So that company's kind of different. When you look at just like the pioneers and the good companies of the world, I think that they're still relatively cheap versus other stocks I think they're all really cheap stocks, but they don't compete with what we're finding. And that's just the nature of a fund of our size and the expertise we have. Like, we're finding, we scour well data to find companies whose wells are getting better, and I don't know if you met Chase, our oil analyst.
He hasn't yet.
He grew up outside of Dallas. What's his name of his town? Something Springs. It sounds like a movie town.
I'm blanking on it, but you're right in that it sounds like a movie town.
Sulphur Springs?
What?
Was it Sulphur Springs?
Yeah.
Okay.
Yeah. That's where he's from. Anyways, you're laughing because, it's like got a hotel that has boarded up windows in it or something. Yeah.
Oh yeah, no, and that's a great. By the way, that's a great name from a town for your oil analyst to be from. So.
Yeah, exactly. Yeah. So we've always found that from a micro standpoint, and I think it's why we've done really well in oil, regardless of the cycle, is because we've had a process here that is ROIC and change focused, and so we've made money both long and short because of that. Full cycle, and we don't have any shorts now because I think that the world has a problem with oil supply. So we haven't had that for a while. But I just love the space from the micro standpoint. And what I'd say about that too is historically you'd have moves in stocks. Like, let's just go to 2018 or 2019 when there was more assets allocated to energy funds and energy in general. you pick a company, the company would be up or down 5 or 10% on a day, and there'd be no news. And then you'd go check the state level data, and you're like, that well, they drilled some awesome wells, or their wells started to suck, depending which way it goes. And you're like, oh shit, this is like pretty efficient. It's kind of like how these pods track credit card data, and like they know what the quarter's going to be before it's going to be. It's not like that anymore. Like, because we check every month. Every month we have a process where we go through all the public wells, and we find, companies that are. We have we have a software, but we also have a system to figure out outliers on what, and it's not priced into any of these things. You get to look at this like, holy shit, this company's drilling huge wells, and no one gives a shit because no one's looking anymore. So it's not just like that. So it's even more like. It makes me even more excited, and it's like the only question that you can't answer is like, who's going to buy these things, right? Because it's like, the money's leaving. Well, the money's leaving, and then the only people that know what they're doing, I believe, and I don't want to speak in definitives because there's obviously people that know what they're doing that don't fit this profile, but it's the people most of the smart guys that I know, guys and girls I know, work at pods, and they don't have the duration to stay long anything. So they're always doing relative value, this or that. And like I was on this last year, it was like I only went on one of these things. It was like an Energy PM Zoom call that Morgan Stanley hosted with all these like big wig guys, and actually it was all guys, so I can say that, Christy, it was all guys.
Unfortunately, maybe one day.
Yeah, but the Energy PM universe was all guys. So I'm on this call, and I was just like, hey, they're like, everyone's talking about nat gas and this company, that company, and then I didn't want to say anything because I felt out of place. And then I just said, yeah, I'm just balls long oil right now. Like, I don't understand. Oil's $40. It's got to go to at least 60. And at 60, all these things are triples. And then they're like, well, when's it going to happen? I was like, I don't know. Like when the vaccine comes and COVID goes away. But we all know that oil shrinks below 50 in the U.S. So it's self-regulating. And this is a chance of a lifetime. And I just said it once. And everyone was just like looking at me like I was smoking crack, because they might not even, and I think some of the guys that I talked to after were like, well, I believe that, but I can't do anything about it. Because if they have a down 5% month, they lose their job. So I just think the space is still super inefficient, and there's lots of reasons why we're still there, and it's still our core long, and I'd say. So anyways, that's oil.
No, and look, I would totally agree with you in the sense of, I mean, there is so much. Well, I mean, it's I think very structurally a very strong, interesting place to be long, but I mean, there's so much dispersion that there's just too much volatility in the space to be a pawn shop. Like, and it's. I think you'll end up in the right place, but it's going to certainly be a bit of a wild ride to get there. So.
Yeah, and it's like, Laredo's a core long, and it goes up or down 5-7% a day, and I don't care, like I understand what we own it for and why, and it's a 4% position. I think it's going to triple over the next 18 months.
Yeah.
And the reason why it exists, that opportunity exists, is because of the volatility. And I really think one of our core competencies at Maple Rock is dealing with volatility, both structurally by our long and shorts, and how we have cyclical short against our cyclical longs, so that we can handle some of the macro vol, but also like individual positions. Like, I can talk about this, and I can and it's only 4%. Like, so you'd ask, why isn't LPI 10%? And because it should be based off of the math. But we had SM that we bought at $2 and sold at 28. And it got to 10% organically, and it was the same thing. It was going up or down 10% a day, and I realized that I couldn't. That was too big. That was too much for me. Like, so like, I learned that, like, okay, even though SM was really cheap at $10 and I thought it was going to 25, I couldn't take moves that volatile in one name. So now LPI is 4, not 10. So that's just me, because I need to concentrate on other things. But still, I mean, that's. Fucking that thing.
You guys crushed it on SM too, so like, I mean, that did really well. But like, one thing I do want to kind of pinpoint more, just to get a better feel for the energy book, and like, I mean, so we talked about this 2 names, but just maybe more stylistically. So maybe this isn't the best contrast, but I think it's an interesting exercise because like everything is so dirt cheap. Like it's not like you're just buying value. Like there has to be kind of something else. So like I think so like there's two groups we know they've approached differently. So like I'm sure you're very familiar with like Oasis, that story, and how it's like super cheap, but like there's really not much growth. I know they have at least some hedges on production. So like you're really just buying value there, like value. Versus like, how do you think about, okay, I'm willing to pay a little more. It's still super cheap, but then like, what other levers are you looking at? Whether it's growth, balance sheet lever, I mean, just kind of other things that are really important in this environment. And I think it's probably a given that it's going to be cheap on some level. And then just like, what are the other really important things for you?
Yeah. So the Canadian names I like better than all the American names generically, like, because they have, I think the U.S. guys are like Oasis, for example. Like their drillable inventory flexes when you take the oil price up a lot, but their core inventory is, I think, 2 or 3 years of like really good stuff they have. And so then they have a bunch of acres that at $60 oil is shit. Like it doesn't make money. It's at 75, you're going to want to drill it to keep production flat. But like, is anyone really going to put a multiple on this? And then you're it's just not the highest quality of assets. So you have a higher discount rate, or you just NPV it, right? Like, and we use NPV as our truth teller in terms of what cheap is, not free cash flow yields. So, so the Canadian guys I like the best because they have, NuVista has 15 years of core inventory, and Paramount has 30 to 40. They have so much acreage that's really good. It's kind of crazy. So you kind of get the growth option. So in a bull case scenario where these companies get paid to grow again, they actually can grow. So then when you're looking at a multiple, it's like, okay, well, Paramount and NuVista are trading at 25% free cash flow yields, and then. But if they get paid like, historically the growth stocks traded at, 7-8 times EBITDA. And so if you get this bull case scenario, the upside is actually much higher for the Canadian names that have drilling inventory. And I don't think the U.S. names can do that because they only have 9. Like Oasis can't jack their budget and start growing. They just can't. So you're just dealing with this like, so and I don't think like on an NPV basis, the value, unless you use like 18, like if the discount rate's really high, you'll get, near term value in Oasis versus some of these other things. But, the whole thing is that the space has to be investable again. And if the space is investable again, the discount rate has to come down to 10 from something that's way higher. Then you have something that you want something that has some growth. And then we have Cosmos. We own Cosmos, which is offshore. I mean, that stock is that's not really, that just stock is ridiculously cheap and on a free cash flow yield and on an NPV basis. It's the cheapest thing we own, and it's because it's an offshore company, and like oil plus offshore, it's like a leper that it's like the blind leper, not just the leper, right? Like, because to go offshore, you're dealing with production misses. Right, which you don't really worry about with, but anyways, Cosmos, Oxy sold an asset to Cosmos, a non-op interest, and this just goes to show that there's no buyers for these non-op interests. Is that they sold it at a discount to where Cosmos was trading, and Cosmos was trading at, we think, like a 70% discount to NPV. So that one is just kind of, there's nothing really special about that. It's just they have a development asset now. They're building it offshore Ghana. It's world class. Their free cash flow yield currently X that is high, including that's not so high. In 12 months that turns on, and then this thing is like a 60% free cash flow yield, and it has a 20-year reserve life. So that's just really, really cheap. But you have to wait a year for that free cash flow to show up. So. That's that, and then Laredo is our other big position, which high quality acreage and really good management. The management team changed in 2019. We used to be short this company. They had they thought it was oil, but it was really gas in western Glasscock County. And the new management team, and these guys, the old management team kept like marginally drilling on the edges of this, trying to pretend like their core acreage was good when it was shitty. And we were short this. We made a lot of money shorting it. And then the new management comes in and is like, our core acreage is shit. We need to do something drastic. So they started buying acreage in Howard County, and they've hobnobbed, they had 2 years of good acreage, and they came out and said, we only have 2 years of good acreage. We're going to buy things. And they ended up selling their gas at PDP and buying a block off Paramount for the same price at PDP, with getting a bunch of acreage for free. So they're really benefiting from the situation that you described privately. And so that's the special part about them. They're not going to grow organically because they don't have enough acreage, but they're the ones, $2 billion market cap. They do 2 or 3 more $200 million deals, then they can start growing, and the valuation mismatch is just massive. So it's kind of, on an NPV basis, it's up almost as much as Cosmos currently, but still, with only 7 years of inventory, they need to do one more deal, and I think they'll do it. These guys have done 3 really good deals, and the management is very self-aware. And in terms of like management teams, and then the other part about all these things is we're very comfortable with the management teams that run these companies in regards to what they're going to do with the cash. And that's really, really important, right? And so LPI is going to do accretive deals, pay down debt, and do accretive deals if they're there. Paramount's going to buy back stock and pay down debt. NuVista's going to pay down debt until they get to, in 2 more months, they're done paying down debt, and then they're going to buy back stock until they trade at a 10% discount. So you kind of have to, I think it's important what the management does with the cash. So like, I'm familiar with Oasis as NPV. Yeah, I don't know, I think the stuff we own smashes those value names out of the water, because they have the concept of unpriced optionality, right? I think the times to own those value guys is when they're really levered, and then they can make enough money to pay down their debt, and they're not going bankrupt, and that kind of period of time's over. So SM going from 2 to 15 was them their price is bankruptcy at 2, and then at 15 they went to unbankruptcy, and then now it's like, oh, this company's actually got really good acreage, so it's a real company. And so to go from like not going bankrupt to a real company, I think that you have to have good assets. So,
well, I think we very much agree with kind of that approach, because like as we've added like a decent amount of oil and gas exposure, talk to people, either that's all they do or mostly what they do, and I do think your frame of thought's the right one, because there is, it's dirt cheap. You can find really cheap assets anywhere, but I think that's not enough right now. So it's just helpful to hear how you guys are thinking about it.
Yeah, you need a margin of safety from either, you need a margin of safety in some way, because these aren't, recurring revenue SaaS companies.
Yeah.
This is a tough business, and everyone's feeling good right now, but management matters, and I think that the management teams in general in oil and gas companies are really bad. So.
I don't think many people disagree with that one.
Yeah.
So. Okay, no, that's super helpful. So maybe just kind of other big parts of the book, I would love to just spend a little bit of time on that to make sure that we have a.
Well, so on the long side, we got about 9% long aerospace, and when you look at the global air fleet, if you think of the trend GDP, like if you can visualize this, it's actually similar. It's actually similar to oil, but less. I'll just show you this. If you just look at, we do this across all kinds of things that have been hurt by. This would be GDP. This would be demand, and GDP would be like.
Zave's inner professor is coming out.
Hold on, let me get it.
I know I'm in trouble when I'm in his office and he starts getting up to the whiteboard and start drawing graphs.
Right, so.
It's just a little tougher with Zoom, unfortunately, but we can make it.
Yeah. We can try.
So this is GDP, this would be. So here's air miles traveled, and you can do this for oil demand. It's on line with GDP. They both go down because of COVID, right? GDP comes back, and GDP's back on trend. which it is. Global GDP is back on trend, and now aerospace is kind of like, aerospace is kind of back to here. But when you look at this point right here in the future, that point there in the future, which is, we can say that that's the end of this year or next year, you need a bigger fleet. Like, you need more airplanes than you had. So this is 2019, right? So people do this, like, you need more airplanes than you had in 2019. And you have less airplanes than you had in 2019 because freight's been so short. So you've converted a bunch of wide bodies to freighters, but narrow bodies, there's only 2 narrow body producers, Airbus and Boeing. And the 737 MAX has been non-approved for 2 years, so they haven't delivered planes. So the fleet's going to be, like, on a normalized world, the fleet's going to be super tight. And so it's not, I think it's one of the easier assumptions to make that orders and deliveries go back to peak or above peak. So that's one of the general assumptions we make to be long aerospace. And so Spirit is a big position of ours. The stock's $45, I think. On normalized delivery volumes of the 737 MAX, it does $9 to $10 of free cash flow a share. So we think this is $100 to $130 stock. So when at some time in the future.
Do you want to hit like Europe reopening, autos, travel, some of the others too while we have time?
Yeah,
that'd be great.
Yeah, Europe. So then we have another company that's exposed to that's in a turnaround, Triumph Group, that we've owned for a long time. We think on normalized volumes, and it's a triple. It's got more depth in Spirit, so it's a little more torque. And we have Europe reopening. We're along Accor hotels, a mall, and a service company that provides food at sporting events. And just one of the things you've noticed, if you look at if you look at Simon Properties in the U.S., Marriott, Hilton, these companies are looking through COVID and trading above 2019 levels. And the European companies that are in the same spaces, and a lot of them are global and exposed to like 80% of the same markets or 70% of the same markets, are trading at half price to those companies. And so it's actually not that. I could talk to you why that exists, and we can make fun of Europeans, or we could just say that the U.S. is the most efficient stock market in the world and prices things faster. And so we have about 6 or 7% exposed to those 3 names. And I think you could do something similar, and you might see us do something similar globally in some emerging markets countries. Brazil, Japan's kind of like this. So that's that.
Autos,
yeah, autos is kind of one of the easier cyclicals. You're at trough SAR right now, and that's because you can't make the cars because you don't have the chips, and the inventories. If you look at used car prices, it's similar to aerospace, except the demand's already back to trend, and the supply is constrained, and you see that in used car prices that have gone up like a gazillion times. And so you know that the demand is there for cars. You look at savings rate in the U.S., et cetera, et cetera. So we think we go from trough to peak SAR in about 6 months. And then Omni has caused some of these autos to go. So we're along a few auto suppliers, one Torquey, one, 2 that are good businesses. One's a semiconductor company, and they have between 50 and 150% upside depending on how torquey they are. And it's just basically SAR going back to peak in 6 months. And we feel comfortable with that because the bottlenecks for semiconductors went from Taiwan to Malaysia. So there's plenty of chips, and then the chips needed to be assembled in Malaysia. And Malaysia got nailed by Delta, and we don't think Omni matters. I don't think it's going to, especially if you're an emerging market, you just deal with it. So that's like I know that's oversimplified, but it's kind of like, it's one of those things where it sort of reminds me of oil before the vaccines were approved, where it's like, this is pretty simple, and the industry's hated, like auto suppliers are hated because EVs are taking over and all these other things, but a lot of them are exposed to EVs as well. So they're just highly operationally levered businesses, not great businesses. But I think the cycle, when you have something that's going from trough to peak, that's pretty predictable, and you're trading not at trough valuation, but well below mid-cycle valuation, that kind of unpriced optionality is something that's really attractive to me. So we're there.
And not thematic, Zay, but maybe it's been a while. Maybe we touch on like Arch and NRP and Smarco, maybe.
So like just random cheap things. If you want to talk about cheap oil stocks, some of the our Arch Resources, it's not called Arch Coal anymore. Sorry. They changed their name. Arch Resources makes metallurgical coal, and at spot prices, which are exceptionally high, they'll free cash flow their EV in the next 12 months. And on a normalized basis, we think they do $25 to $30 of free cash flow share, and the stock's 95. So it's like this thing should trade at 5 to 7 times free cash flow plus $100 of super profits. So we think it's a double to triple, and it's something we've held for a long time. And because it mines coal, even though it's metallurgical coal, it's traded at a severe discount. But they're good capital allocators. We've owned this company, we know the management. We think that they'll do a combination of buybacks and dividends, and there's a huge margin of safety here. So I think that will be something that will be in our portfolio for a while. And one of the things you're seeing from a macro standpoint in regards to ESG and carbon emissions is China's trying to limit their carbon emissions in their 5 and 10 year plan. I'm sure you've read about that. And if you look at the large carbon emitters in China, you're talking about aluminum, steel, and cement are the 3 largest carbon emitters in China. And so we think that Chinese steel exports over the next 5 to 10 years will decline. And they'll be replaced by new steel mills in India, basically, which is a poorer country and is allowed to it's more socially acceptable for them to emit carbon. And India has captive iron ore mines. A steel mill needs iron ore and coking coal to make steel, and India has no coking coal and has abundant iron ore. And so we expect secular growth in coking coal because of these Chinese ESG policies. So it's very interesting in terms of from a risk reward standpoint, because the S&D is secularly growing, we believe, due to ESG policies, and the valuation is suppressed due to ESG investment policies. So like if I pick one name that has the most tailwinds and the cheapest price, it's this one. And we have another smaller version of this that is a little torquier, not as low cost, a little more debt. And so we have together, those are about 7%. And it's
Arch. Or go ahead. Sorry.
Yeah, and I just think it's like one of those things where we're trying to defend our ESG. I'm very aware of ESG policies globally, and it's a huge part of our investment research.
Yeah.
But it's my job to compound for our LPs.
Kyle, did you say how big was Arch, by the way?
No, how long have you had it? Actually, it feels like I've seen this one popping out of people's portfolios for years now.
We've owned this since bankruptcy. So we bought the bonds. We bought the bonds in bankruptcy in 2016, and I think it emerged in 2017. And this kind of $30 a share of normalized free cash flow, a $200 target has been our target forever.
Okay.
Right, and so. We've trimmed it and bought more, but it's been around for a long time. Yeah, I think I think our work on coking coal has been correct. It's proven to be correct, right? And because it's called coal, no one wants to invest in it. So again, it's even worse than oil. Like that word is really bad, but there's no solution to making steel without it, even close to economically. So, there were people who are working on it, but they're talking about $2,000-$3,000 a ton steel versus what will be $700-$800 a ton. And so the emerging markets where all the growth is coming from, they can't afford $2,000-$3,000 a ton green steel. They'll buy $600-$700 a ton steel from India.
No, I mean, it's interesting. So, I guess the last question I have, so I just want to make sure, again, just get a good feel for at least the exposures you have in the portfolio.
Yeah.
On the short side. So, I mean, it almost sounds like it's you're autos, airline. I mean, there's kind of that.
Yeah, there's some cyclical long exposure, and then on the cyclical short exposure side, we have a chunk of cyclical China short exposure in basic materials, in steel, in aluminum, and we're adding some of that now because I think Omni's going to be a problem for them.
Yeah.
But when you look at autos, when you're at trough, it's kind of like, okay, well, as a risk manager, I take that and I put it aside and say I'm not hedging that because I don't need to. It's at trough. Like what we did this is what I learned from 2016, Kyle, was if you're at trough, you don't hedge with other cyclicals at trough. You're just wasting money. Just reduce your grosses and nets, or just reduce your grosses and just stay long that stuff. And so things that are at trough, I don't want to hedge them, because I just found historically just end up losing money. So autos are at trough, so I take that and put it aside. Aerospace is close to trough too. It will go down if the world blows up. So I mean, like I'm not academic about this and not realistic, but that's close to trough as well. I think the oil is its own thing, and I struggle with China growth and I look at copper, aluminum, and steel that are above mid-cycle valuations, above mid-cycle fundamentals, and their supply coming. And so that's what I like. That's what we're looking at now, and we're in the middle of studying what happened in Xi'an, where they totally shut down, and because Xi'an is in Shaanxi, which Shaanxi is a province where they mine coal, and so you'll have aluminum smelters, steel mills, titanium dioxide plants. You'll have everything in that city. And so we're digging right now to understand if they shut down the plants or if they just shut down the construction, right? So like we're trying to determine what that shutdown means currently, and I think that I'm a little bit too long cyclicals considering where China is. So that's something, and that's something that's been very fluid in studying Omni over the last 6 weeks. So then you're like, okay, do you reduce cyclical exposure or do you find shorts that are more linked to China? And what's interesting about the next 12 months versus the last 12 months, the last 18 months, from my standpoint, is this is more normal in that there's things that are above mid-cycle or close to peak that you can short, which last year there was less of that, right? You were in this reflation and you were below mid-cycle, and shorting that's just a waste of money. And now you're at a period of time with petchems, where petchems refining, there's stuff that's close to peak again. So the short side is much more attractive, and I actually feel better about the next 12 months than I did the last 12 months, because I think there's a chance we make money on both sides of the book, and the opportunity set. Whereas last year it's like, okay, fuck it, I'm gonna go long because this is stupid, right? And that involves daily volatility, and the fact that we built our business to withstand that, and LPs understood it, was why we had such a great year. But that was a conscious decision for me to put myself in pain for a whole year, right? And I think the next year, I think the current environment's going to be more balanced, which makes me happier because I like short selling too.
Zabe, I hate to play timekeeper, but Kyle, we have about 5 minutes because I have an OGD meeting, and Zabe, you have the guys for the investment meeting. So I just want to kind of give the 5-minute warning here.
Okay.
No, I mean, I think this is great for me. So thank you guys for taking the time. Chrissy, thanks for getting up so early. I mean,
we saw the sun come up there. It was dark when we started.
I was going to say, actually. I mean, any questions for us? Like, we haven't, I don't think really a ton's changed since we spoke, Christy.
That would be my question, to the extent that anything's changed since our dinner. Obviously, we talked in depth then, but to the extent that the portfolio has changed dramatically since then, or any of the team in terms of what you're focused on today, or anything related to our firm that we should be aware of as we business plan, etc.
Yeah, I wouldn't say anything for you guys in particular right now. I think if performance keeps being really good, we'll probably have to trim a little bit just for sizing. But I mean, I think that's just kind of around the edges. Look, so we're 3 now. So we have Kim, myself, Yonga. We're starting to really work our way through a lot of hopefully putting a lot more names in the book.
Mhm.
So, we got out of kind of the more macro lever trading kind of things. Much more in favor of like fundamental stuff. Cliche as that might sound. So look, yeah, like energy, materials, industrial has actually been a big focus.
And can you remind me where we're sized position-wise for you guys as a percent, and like where your cap tends to be?
You're probably one of our bigger. We still don't have a cap, but you're definitely our biggest hedge fund actually, and that's all just because you guys have done very well the past year and a half. So, what, you're around 40? I'm guessing 40 million.
Mm-hmm.
So that's 2%. I think that's fine, but like once you start getting to like 2.5, like it's probably like the 2 to 2.5 range that where you max out, I think. So it's just like a rough rule of thumb. Like we don't have
any hard and fast rules.
Yeah, like we could get up to 6%, but I'll tell you right now, I'm not comfortable having any hedge fund 6% really at the moment.
And I would just say on my end, obviously, to the extent that we feel like we're bumping into that number, the sooner we know, the better, especially because as we're replacing the capacity that we have with a couple new groups, I'm obviously limited to what we can take in based on what comes out. So if that number shifts at any point, just let me know when you can, and it's always helpful on my end.
Yeah, definitely. And like I said, I don't see it being an issue like for the foreseeable future, but just like, kind of, if you keep having 50% years,
well, let's hope it's a problem at the end of this year again.
Definitely. But no, look, I think I think it fits really well. We've done a lot of work on inflation real assets. So we kind of rebuilt that whole portfolio. And I think those are good exposures to have. And I think you guys have been really helpful with us reaching that this year. So yeah, it was helpful to just kind of get an update. Thanks for taking the time.
Yeah, it was really good to see you. Hopefully, we'll get to do it again in person soon.
Awesome.
Well, thank you, brother. Yeah, take care.
Bye, guys.
Bye.